We'll hand over to Jan. Thank you so much again for that. I think in the interest of time, we'll keep on rolling. Jan, welcome. And again, thank you very much for your time.
Thank you very much. Good afternoon, ladies and gentlemen. I've been asked to do the impossible, and that is to discuss hedge accounting in sufficient detail to make it understandable in 15 minutes. But I'm going to do my best. What we're quickly going to just go through is just one or two of the basic things about hedge accounting. So what are the key things to think about? And then I'm going to get into some practical detail of what are the things that you need to consider when you're actually looking at commodity type derivatives, and we look specifically at these oil ones. What are the sort of the practicalities that the standard requires us to think about? So for those of you who are involved in financial reporting, you'll know that IAS 39 is the accounting standard that deals with financial instruments and derivatives. And the default accounting for derivatives are very simple. It's just we mark to market them through P&L, so it just goes through the income statement. The contract sits on the balance sheet, either as an asset or liability or as cash, if you pay them variation margin, and the contra goes to the P&L. So none of us can pass one-sided journal entries unless you're Chuck Norris. So therefore, the P&L unfortunately ends up in the income statement. So the problematic thing for most of our clients are when it comes to the valuations, you need some tools to get the fair values calculated, but the benefit from using exchange-traded derivatives is that you get the mark-to-market on a daily basis. So if you don't have the capacity to actually do the calculations, it's a lot, it takes a bit of the admin burden away. So you will also know, if you're involved in financial reporting, that IAS 39 is going to be replaced by IFRS 9. There's some new rules on accounting for financial instruments and also hedge accounting. So part of the objective of IFRS 9 is to make hedge accounting a lot simpler, make it more practical from an economic point of view, so that it matches the economic thinking of hedging and not have such a wide range of rules, stringent rules that we currently have to deal with under IAS 39. That standard, the changes to the standard has already been published. They made some changes last year again. Comment period ended earlier this year. We're not too sure exactly when this new standard is going to be published. It may be in the latter part of this year, only effective 2015, so there's still some time that's going to have to pass before I think it's going to be applied mainstream. But we'll mention some of the issues that will come out of that. So what is the concern with general derivative accounting? And typically we have two types of mismatches that people are concerned about. So if you are a hedger and you are using this derivative for hedging purposes, typically the derivative is taken out now, but you are hedging an exposure that is only going to affect your financial statements in the future, or the cash flows may only occur in the future. And therefore you've got a bit of a mismatch where the derivative P&L already goes through your income statement at the moment, but the underlying transaction will only hit it in a different time frame. That's where we get the accounting mismatch. That's the big concern with using derivatives. The second one is also what we call the geography mismatch, because depending on your accounting policy, you can either account for the derivative P&L in the line of the underlying hedged item, or it could sit in a different line in your income statement. So you would have the derivative P&L in one line, have the exposures P&L in a different line, and you don't show the economic reality of what you achieved with your hedges. So that could be another benefit from hedge accounting. That's typically why one would consider doing that. I'm not going to go through the technical details, but I'm sure you all know hedge accounting's purpose is to align those mismatches, but there's lots of rules. You have to earn it, you have to have some documentation in place that describes the strategies and the things Johan mentioned earlier. You have to have an effectiveness test. You cannot decide later in their life, oh, I actually wanted to do hedge accounting, and backdate it. You can only do it prospectively. So there's a couple of rules that one needs to look at. Considering that you can meet those rules, let's get into the practicalities. So if we want to use derivatives for hedging purposes, we need an underlying exposure. So what is the thing that exposes us to risk? What is the thing that we're interested in hedging? Now those could be a couple of things. So the one thing could be a highly probable forecast transaction. So it's to use if you think of Gerard's example, that diesel consumer, he had a forecast that he's going to be using the diesel in the future. So he might not have a commitment to purchase it or order it yet, but if he has a highly probable, there's a high probability that he will be using that diesel, that would qualify for hedge accounting purposes. The one that gives us more certainty is a firm commitment. So if I have an order to purchase a certain commodity, I've got a commitment to sell it or commitment to buy, that'd be a firm commitment, that also qualifies. And another one is something that you already have. So I could already have this commodity or asset on my balance sheet, and I'm perhaps concerned that if the value, the price could drop and I would have to book an impairment through my P&L, for example. That could also be a valid hedged item. So I'm going to use just the fuel analogy because we're using this oil derivative, because I guess that's probably the most, one most people would consider. How do we actually make hedge accounting work? Well, there's one of two ways you can do it. You either do a fair value hedge or you apply a cash flow hedge accounting. So the fair value hedge is a methodology where we actually advance accounting for the risk of our underlying hedged item on our balance sheet. So how does the accounting work? We actually take the value of the derivative, change the fair value through P&L. You're saying, how does that help us? Because now we've got it in the income statement. But fair value hedge accounting overrides the normal accounting for the hedged item. So typically I could have an order, so this works for firm commitments. I have an order placed to, let's say, purchase fuel. I would normally not account for that until I've received the fuel. But fair value hedge accounting would allow us to fast track that risk and actually bring it onto the balance sheet and through my income statement. And then in theory, in the income statement, if your hedge is set up properly, those two P&L should offset, and that would give you a nice neutral situation in your income statement. The alternative, which I think is probably more applied in practice, is the cash flow hedge. So that's the alternative methodology of deferring the effect of the derivative. So how do we keep the derivative P&L out of the income statement? We put it into a reserve in equity, and there we retain it, assuming it's effective, until the underlying hedge transaction occurs. And then depending on your accounting policy, you either capitalize that into the underlying hedged item, or you release it to P&L so that it matches the impact of the underlying instrument. So you can see the two contrasting methodologies. The one is let's fast track the risk through P&L, the other one is let's defer the accounting for the derivative through P&L at a later stage. So those are your two strategies, the way of getting rid of that. Now, what are the key things to think about? So one of the inherent things one has to consider when you're dealing with exchange traded derivatives, and I think both Johan and Chris, Harald mentioned that, is that you've got fixed maturity dates, you've got fixed contract sizes, and there's a specific location that the derivative refers to. So that could give you some ineffectiveness, because if your price of your underlying hedged item references from a different location, there could be a little bit of basis risk between those. Or the contract size determines, I can only buy 100 barrels of exposure at a point. You need to sort of figure out how many liters that equates to. So if you buy two contracts, it doubles the liters. You can't hedge the liters somewhere in the middle because the contract only allows you those fixed quantities. So you need to figure out how you're going to make your notional amounts balance. And then the fixed maturity dates as well. So there are ways of dealing with that where guys can sell contracts earlier, etc., to get to that benefit. But it's you need to realize that I can't just take out a derivative that says I'm going to hedge the purchase on date X, because exchange traded derivatives work a bit different. The key thing you need to think about when hedging commodities is that there's a very unfortunate rule in IAS 39 at the moment where it deals with hedging non-financial items. And it has the assumption that one cannot quantify components of a non-financial item, and therefore they made a rule saying that the only component of a non-financial item one can actually hedge account is foreign currency risk. So alternatively, you have to hedge account the full price risk of that item. Now, any cost accountant will tell you that's sort of ridiculous because we know exactly what is the building blocks of many of our products. But unfortunately, that is a rule that sits in IAS 39 at the moment. So from a practical point of view, what does that mean? So if you look at my simple example I put up on the screen there for fuel, the fuel consists of a combination of refined petroleum, some shipping costs and insurance, storage, etc., and some taxes and margins that the government regulates and slaps onto that, and that's how we get to our pump price at the end. So as a hedger, you would be concerned only to hedge the oil component within this refined petroleum price. And one can actually calculate that because you know exactly how the formula is put together, and you know how much oil it takes to manufacture petroleum, etc. But unfortunately, the standard says I cannot cherry pick the oil within the fuel. I have to hedge the complete fuel bill. So therefore, unfortunately, you can only hedge the changes in the full pump price, and you cannot just cherry pick this portion, even though that's economically what you're doing. So what does that do from an accounting impact? It just makes the admin a bit more, because one has to prove that the change in the value of this derivative, which only looks at oil, is actually effective in negating the risk on that full pump price. Now, from a common sense point of view, if the shipping, insurance and storage is a small component and they do not vary significantly, the taxes remain constant every year, it's not necessarily a huge problem. but you can just see there's a little bit of extra administrative effort involved in proving the mathematics works. Now, fortunately, the ISB has listened to all our complaints and those of our clients about this rule, and under IFRS 9, they are proposing to change this rule to say that one can actually hedge components within non-financial items as long as they are separately identifiable and reliably measurable. So those are the two tests. So the question is, how far can you go? Can you hedge the cocoa in a Mars bar or something? So those I think are going to be interesting debates. But for now, if we look at this example, if you have a fixed formula, you know exactly what the components are, you can identify the component. Hedge accounting in theory should be possible under the new standard. So thinking about effectiveness tests, that rule has a big impact on the effectiveness test because that is the most admin that you have to do from a hedge accounting point of view. Now there are a couple of hedge effectiveness tests one can consider. There's two you need to do. You need to do a prospective test. So that's a test when you start your hedge accounting and starting of your financial period. You have to prove that your hedge will be effective in the future because that sort of gives you the go-ahead to get hedge accounting. And then you have to do a retrospective test, which is when you get your reporting date. You actually have to calculate your actual effectiveness to prove that your hedge strategy did work according to the ratio required by the standard, and that gives you the journals that they will post. So there's a couple of approaches to this. The one is to use a critical terms match approach. So you can think about it if a derivative is critical terms, the notional, the currency, the date, everything exactly matches the underlying, sort of a no-brainer. Your hedge is going to be reasonably effective. Now this test is unfortunately only allowed for a prospective test, not a retrospective test. So when you get to your reporting period, you still have to do some mathematics to prove the effectiveness. Now you can see from our previous slide, if I've got an oil derivative hedging a fuel pump price, I cannot use critical terms methodology because I'm not hedging the same thing, albeit because forced by the rules in the standard. So the method that most people use, and this is required by the standard, is the dollar offset or the ratio offset method, where you actually compare the change in the fair value of the derivative to the change in the fair value of the underlying. So it's two mark-to-market calculations that one has to do. And this is not looking back and saying, oh, when the cash flow is realized, they actually worked. This is a forward-looking thing saying the mark-to-markets of this relationship actually offset. And they have to be within that 80 to 125% barrier that's required by the standard. Now, this works very well where you have very vanilla sort of relationships, but if you think about our underlying situation, what happens if the taxes move? What happens if the shipping costs or the other components of this fuel price moves? Then that 80 to 125% ratio of ours could go out of sync, and that would kick you out of hedge accounting. So that's why for these type of scenarios we use a regression analysis. And all the regression analysis is, it's a series of these valuations. So we do a lot more of these valuations over a period of time. You can see like the red dots there in the graph. So you will plot a regression profile across that, and normally it gives you a lot better results because the outliers get smoothed out of depending on the size of your population. And that's typically the scenario that we would, or the solution we would suggest to our clients when you're looking at this type of strategy. Now, something to note, in the new IFRS 9, they've also made this a bit simpler. So this rule of 80 to 125% is going away. So it's becoming more economic. So your hedge effectiveness is based more on economic principles. You've got to prove the economic relationship between your exposure and your derivative. You don't have that 80 to 125% bright line anymore. So there are some administrative issues around that, but in general it's a lot simpler and a lot less rules based under the new standard, which should also make things a lot more practical going forward. The last thing I quickly want to mention is, think about options. Jan mentioned the components of the options and how they work, and it's just worthy to note that hedge accounting for options is a little bit different from normal derivatives, if I can call it that. And the reason is with the way that they're actually structured, the way the mathematics work, and the way they put together. So if we look at just a vanilla option, normally you would use it to either only hedge one-sided risk. So where a future contract takes care of risks, price movements above and below a certain level, an option normally just takes care of the one-sided movement if it's just by itself. Now, the building blocks of an option very basically is made up of intrinsic value and time value. So what are those? The time value, that's sort of the premium that they mentioned. That's the insurance cost. That's the part that potentially can give you value in the future. The intrinsic value, that's actually the benefit at the end of the day that the option will derive. That's actually the portion that gives you the payoff and the desired result. Now those two together generally gives us the fair value of an option. Now, because of very complex rules in the standard, one is not allowed to impute time value into an underlying risk position because there's no such cash flow in a risk position. The only instrument that requires a cash flow for time value is an option when you pay premium. But an underlying hedge position does not include such a cash flow. So typically it's only the intrinsic value that gives us the benefit. So generally, unless you're running a very complicated delta hedging strategy, from a corporate point of view, you would only use the intrinsic value of the option for hedge accounting purposes, and you will split out the time value, and that would go through your income statement over the life of the derivative through the mark-to-market process. Now, that could give you some volatility if you have spikes in the time value, but generally, that is a risk that unfortunately under the current standard there's nothing you can do about that. You can only isolate the intrinsic value for hedge accounting purposes. So that's worth noting, again, under IFRS 9, they're becoming a lot more practical, and IFRS 9 realizes this problem, and they've suggested now that you can also apply hedge accounting to the time value of the option, not just the intrinsic value. So changes in the time value will then also go to your hedging reserve, and the time value, your actual time value expense, will then go through your income statement depending on what is the underlying item that you're hedging. So if you are hedging a time-based occurrence, so something that hits your P&L over a time period, the time value will be expensed over the life of that time period. However, if it's transaction related, so I'm buying fuel today, that hits my P&L today, or expensing it at that point, then the time value will be released at that point. So you won't get the volatility from the time value changes in your income statement either under the new IFRS 9. So some things to look forward to. The last thing worth mentioning is under options, Johan mentioned that earlier, when you sell an option, you take on risk. And therefore, the standard says if you are the takeoff risk, then you cannot apply hedge accounting to written options. So that's another rule that's in the standard. The only exception to that is if that written option is offset by a purchase option. So when you have a collar strategy, where there's something that offsets, you have to go check that it's not a net written option, so it's got to be a zero position or net purchased, then it is possible to apply hedge accounting to those options. So I've tried to do the impossible and run through this in a very short space of time. Thank you very much.